85.2%. That is the year-over-year surge in core operating earnings per share that Chubb Limited posted on April 21st, 2026. Core operating EPS of $6.82 against a published estimate of $6.60. Net premiums written of $14 billion, up 10.7%, and a P&C combined ratio of 84.0, the kind of underwriting result that speaks entirely for itself. 1 quarter, 4 data points. This is what disciplined insurance looks like.
The context here is critical. 1 year ago, Chubb reported a combined ratio of 95.7% in Q1 2025. That was the Los Angeles wildfire quarter, one of the most expensive catastrophe events in California history. So the year-over-year comparison is stark. From near break-even on underwriting to over 16% underwriting profit margin in 12 months, the business did not just recover. It demonstrated exactly what Chubb is built to do.
I'm Hudson Thomas, and today on Charged Alpha, we are going inside Chubb Limited, ticker CB, the world's largest publicly traded property and casualty insurer, after a quarter that showed an 85% jump in core operating EPS and reminded the market why Chubb commands a premium in the insurance universe.
And I'm Lana Chen. Today we cover the full picture, the business, the financials, what the street says after the beat, and whether the stock at $329 represents compelling value or just a recovery from an easy comparison. Let's get into it.
Let me set the stage on who Chubb actually is. The company traces its roots to two storied underwriting institutions, ACE Limited, founded in 1985 as an excess liability insurer for Fortune 500 companies, and the original Chubb Corporation, founded in 1882. When ACE acquired Chubb in 2016 for $28 billion, the largest P&C merger in history at the time, it took the Chubb name because it carried more brand equity. Today, that brand is a global insurance juggernaut operating in 54 countries.
Chubb operates across two primary reporting segments. Property and casualty is the dominant engine, generating the vast majority of premium volume through commercial insurance, personal lines, specialty lines, and reinsurance. The company also runs a growing life insurance and group health business. In Q1 2026, life insurance net premiums written surged 33.1%, a segment that often gets overlooked in the P&C headline story.
The geographic reach is what separates Chubb from most North American insurance brands. The company writes business in 54 countries, and nearly half of its net premiums written come from outside the United States. That international diversification creates both exposure to global catastrophes and opportunity in markets where property insurance penetration is still growing.
Their competitive moat is built on 3 pillars. First, underwriting expertise. Chubb's ability to price risk at scale with consistent discipline, reflected in a long-term combined ratio that is the envy of the industry. Second, the high net worth personal lines franchise. Chubb is the dominant insurer of luxury homes, art collections, and complex assets in North America. Third, a deep commercial relationship network. Multinational corporations trust Chubb to coordinate coverage across their global operations.
That high net worth personal lines franchise is particularly defensible. Wealthy families with complex assets and high replacement costs need customized coverage, not commodity policies. Once your portfolio is tailored to your specific situation by Chubb, you do not shop for cheaper alternatives. It is the same loyalty dynamic that exists in premium financial services. The cost of switching is psychological and logistical, not just financial.
Q1 2026 showed 2 different growth engines inside one ticker. P&C premiums grew 7.2%, reflecting strong commercial renewal rate increases and solid volume growth across specialty and international markets. Life insurance premiums grew 33%, driven by Asia-Pacific markets where rising middle-class wealth is creating structural demand for coverage. 2 engines, both moving in the right direction.
A global P&C franchise, a growing life insurance business, and a decade of consistent underwriting discipline. Let's talk about who's steering the machine.
Chubb is being led by Evan Greenberg, who has served as chairman, president, and CEO since May 2004. He is the son of Maurice Hank Greenberg, the legendary AIG chief who built that company into a global insurance empire. Evans spent 25 years at AIG, rising to president and chief operating officer, then left in 2001 to join Ace Limited.
What do we know about how he manages the business?
Greenberg is known for his willingness to walk away from business when pricing is inadequate, a discipline he calls underwriting integrity. He has been vocal about not chasing volume in soft markets, even when it costs near-term market share. When Q1 2025 was distorted by the Los Angeles wildfires, he did not panic or change strategy. He ran the business through the cat loss quarter and let the fundamentals reassert themselves. The Q1 2026 result, 84% combined ratio and record investment income, is the reward for that discipline. He raised guidance after the beat, which says the pipeline is strong and the underwriting environment is favorable.
The raised guidance is the tell. Let's get into the numbers.
Let's dig into the financials. At $329.29 per share, Chubb carries a market capitalization of approximately $128.5 billion. That places it among the largest financial services companies in the world by market cap.
What does the valuation picture look like?
On a trailing 12-month GAAP basis, Chubb trades at roughly 11.5 times earnings. On a forward basis, using the midpoint of what analyst models have projected, you are looking at approximately 11.6 times. The price-to-sales ratio is 2.67 times trailing revenue. For an insurer with Chubb's underwriting track record and investment income scale, that is not expensive.
How did the actual quarter come in?
Core operating EPS of $6.82 against the published estimate of $6.60, a 3.3% beat. GAAP EPS was $5.88, up 74% year over year because Q1 2025 was wrecked by wildfire losses. Net premiums written of $14 billion came in ahead of the forward projection of $13.56 billion, a solid beat on the top line, driven by both P&C growth and that 33% surge in life insurance.
Tell us about the combined ratio.
84.0%. That number is the headline. A combined ratio below 100 means the underwriting business is profitable on its own before you even count investment income. 84 means for every dollar of premium Chubb collected, it paid out 84 cents in claims and expenses and kept 16 cents as underwriting profit. The prior year was 95.7. That 12-point improvement translates directly into nearly $1.8 billion of underwriting income in a single quarter.
And investment income.
Record. Net investment income came in at $1,709 million, the highest quarterly figure in the company's history. The fixed income portfolio is generating a 5.1% yield on $175.6 billion of invested assets. High rates have been a favorable condition for insurance companies that run large bond portfolios, and Chubb's scale amplifies that advantage.
Balance sheet.
Total assets of $275 billion, dominated by the invested asset base. Long-term debt of $16.1 billion. The debt-to-equity ratio is conservative for an insurer of this scale. Chubb returned $1,171 million through buybacks in Q4 last year alone, alongside its dividend program.
And the dividend?
Chubb has raised its dividend for 32 consecutive years. The current annual payout of $3.64 per share yields approximately 1.1% at current prices. The payout ratio is well below 15% of earnings, meaning the dividend is highly durable even through a significant cat loss year. Overall, Chubb's financial health is strong. Record investment income, exceptional underwriting discipline reflected in an 84% combined ratio, and a balance sheet that has absorbed every major catastrophe cycle without impairment.
32 consecutive years of dividend increases. That tells you something about how this business has performed through recessions, financial crises, and catastrophe cycles alike. Lana, what does Wall Street think of this quarter?
The Street liked it. Multiple firms reiterated or are expected to upgrade their views after the Q1 results. Goldman Sachs had already moved to buy earlier in the year. Wells Fargo and RBC Capital maintained overweight and outperform ratings. The average 12-month price target from the analyst community sits around $336, modest upside from the current $329. The consensus is moderate buy with 7 buy ratings, 9 holds, and 2 sells.
Some notable downgrades going into this quarter, though.
Yes, HSBC moved from buy to hold, Piper Sandler from overweight to neutral, Barclays from overweight to equal weight. The downgrade thesis centered on valuation after the stock's strong run and concerns about catastrophe tail risk. What the Q1 results did is force those analysts to revisit their combined ratio assumptions. An 84% combined ratio makes the valuation case meaningfully more compelling than it appeared at 95.7.
The stock is approaching its 52-week high.
The 52-week high was $345.67. At $329, the stock has room to its consensus price target of $336 and more room to reach that prior high. Targets are moving upward post Q1, but price targets always lag after blowout quarters. What matters now is whether the combination of underwriting performance and record investment income can hold through the back half of 2026.
CEO Greenberg guided for double-digit EPS growth for the full year. What does that imply for estimates?
If we take trailing core operating EPS and apply double-digit growth, full year 2026 guidance implies something in the range of $30 to $31 per share. At the current stock price, that is roughly 10.5 times forward core operating earnings, a number that looks reasonable for a business delivering 84% combined ratios and record investment income.
Double-digit guidance after a 17% beat on the comparison quarter. That tells a clear story. Let's work through the bull and bear cases.
Let me lay out the bull case first. The most powerful driver is the combination of elevated interest rates and Chubb's massive fixed income portfolio. $175.6 billion at 5.1% generates sustained, predictable investment income that flows directly to earnings. This is the insurance float advantage. You collect premiums, invest the money, earn returns, and pay claims later. When underwriting is disciplined, you get paid twice.
That investment income story is structural over a multi-year horizon.
Over multiple years, yes. When Chubb renews the fixed income book at current yields, the income compounds. The portfolio is rolling at elevated rates as older, lower-yielding bonds mature. Each year of reinvestment at 5% adds to the cumulative NII advantage. This is not a one-quarter benefit. It is a sustained earnings driver unless rates collapse significantly.
What is the second bull catalyst?
Commercial property insurance pricing. After years of elevated catastrophe losses from floods, wildfires, and severe convective storms, commercial property premiums have increased materially across the industry. Chubb is well positioned to capture that rate environment as a disciplined underwriter that stayed in the market through difficult periods. Business written today at current rates flows through earnings for the next 12 to 18 months as policies earn.
And the international life insurance opportunity.
That 33% growth in life insurance premiums is not noise. Asia-Pacific middle-class wealth expansion is a multi-decade structural story. Chubb has been building distribution and product infrastructure across markets like South Korea, Taiwan, and Southeast Asia for years. Once you have the distribution network in place, life insurance premium growth in those markets can be predictable and durable.
Now the bear case.
The bear case starts with catastrophe concentration. California wildfire risk is intensifying, not stabilizing. If the 2026 fire season matches or exceeds 2025, Q1 2027 will look just like Q1 2025. A combined ratio north of 95 and a collapse in year-over-year EPS growth. The market is pricing Q1 2026 as the new normal. One major event, and that assumption gets stress-tested hard.
What about trade policy and tariff exposure?
Commercial property insurance covers the insured replacement value of physical assets. If tariffs inflate costs for industrial equipment, raw materials, and construction supplies, the actual cost to pay property claims goes up. Chubb may not be able to reprice existing multi-year policies immediately when inflation accelerates. That margin compression risk is real and underappreciated in the current discussion around insurer earnings.
Third risk?
Reserve adequacy. Insurance companies carry large reserves for losses incurred but not yet reported. If those reserves are insufficient, particularly given recent social inflation in liability claims and elevated litigation settlements, Chubb could see adverse reserve development that hits earnings in future quarters. This is an industry-wide concern, not unique to Chubb, but large commercial liability books carry meaningful reserve uncertainty.
Let's see how Chubb stacks up against the major names in insurance. Who are we comparing them to, Lana?
3 names make sense. Progressive Corporation, the auto insurance leader that has redefined direct-to-consumer underwriting. Travelers Companies, the commercial P&C insurer that is Chubb's most direct large-cap domestic rival. And American International Group, AIG, the company that Evan Greenberg's father once ran, and that has spent the last 15 years restructuring after the financial crisis.
On valuation?
Chubb trades at 2.67 times trailing revenue. Progressive is significantly more expensive at around 6 times sales, a premium justified by its extraordinary loss ratio performance in auto insurance and dominance of digital distribution. It is a different business model entirely. Travelers is much cheaper at about 1.6 times, a high-quality, slower-growth insurer with a domestic focus. AIG is the deep value play at around 1.2 times revenue, reflecting its ongoing restructuring and lower margin profile.
So Chubb sits solidly in the middle of that range.
In the middle, but arguably deserving to move toward the higher end if the underwriting performance continues. The 84% combined ratio, record investment income, and international growth profile make a case that Chubb's current valuation does not fully capture what this business can generate at peak performance. The Q1 result gave the bulls a compelling data point. Whether it sustains through cat season is the open question.
Let's look at the options market after this quarter, Lana. What does the positioning tell us?
Implied volatility is running at the 65th percentile following the earnings move, elevated but consistent with what you see after a significant single-day price reaction in a large-cap financial. The put-to-call ratio is sitting around 1.05, which is roughly neutral. Traders are not piling into downside protection aggressively, which suggests the market believes this result reflects genuine underwriting strength rather than a one-time seasonal benefit.
Where is open interest concentrated?
Call interest is clustered at the 350 and 375 strikes. The market is pricing in potential upside to those levels if the combined ratio performance continues. Put protection is lighter, concentrating around the 300 and 280 levels. The options market is treating the 300 level as a meaningful support reference. Overall, the positioning is biased toward further upside, not toward hedging a reversion.
What about insider activity?
No open market purchases were filed in the 90-day window before Q1 earnings. At a $128 billion insurance holding company, executive compensation is primarily structured through multi-year performance equity programs, tied to combined ratio, book value growth, and total shareholder return metrics. Discretionary open market buying is rare at this size and ownership structure. The absence of buying is a neutral signal. It tells you nothing directionally about the earnings thesis.
Neutral on insiders, near neutral on options positioning. The market is treating the Q1 result as genuine, but is not blindly chasing the move. Let's talk about what to watch going forward.
The key risk investors need to monitor is catastrophe exposure. Chubb runs a global book of property business. Any escalation in California wildfire risk, Atlantic hurricane activity, or severe convective storm losses through the summer hits the combined ratio directly before reinsurance protections kick in. The Q1 print was exceptional, partly because the catastrophe environment was benign.
Second,
the sustainability of the investment income advantage. The 5.1% portfolio yield is partly a function of the current rate environment and partly a function of Chubb's duration management. If the Federal Reserve begins cutting rates more aggressively and the yield curve flattens, the reinvestment rate on maturing bonds declines. The NII advantage does not disappear overnight, but it erodes over a multi-year horizon.
third,
Reserve development. Social inflation has been driving up the cost of commercial liability claims across the insurance industry. If Chubb is forced to strengthen prior year reserves, those charges flow through earnings and mask the underlying underwriting performance. It is a risk to watch in every quarterly report.
The bottom line on Chubb Limited. This is a company delivering exactly the combination that insurance investors want. Disciplined underwriting, generating an 84% combined ratio, record investment income from the float advantage, and management with the conviction to guide for double-digit EPS growth after a significant beat.
The key metric to watch is the P&C combined ratio quarter over quarter. 84.0 in Q1 is exceptional, partly reflecting a benign catastrophe quarter after the wildfire-distorted comparison period. The real test is whether Chubb can sustain combined ratios in the high 80s through the hurricane and storm seasons of the second half of 2026.
If the catastrophe environment cooperates and the investment portfolio continues generating at 5% plus, Chubb has the ingredients for a genuinely exceptional year. The CEO already said as much when he guided for double-digit earnings growth. The question is whether the back half delivers the same conditions.
Chubb is one of those companies that makes money the old-fashioned way. It underwrites well, invests the float, and compounds book value over decades. 32 consecutive years of dividend increases tells you something about the durability of that model through every kind of market environment. Whether this specific entry point at 329 is right depends entirely on your view of the catastrophe environment and the rate cycle.
Watch the combined ratio. That is the engine. If it holds in the high 80s, the earnings story sustains itself. If catastrophe losses push it north of 95, the valuation narrative changes fast. We'll close today's episode with a quote from Warren Buffett. And given that Chubb earns money by taking on precisely the risks others cannot fully analyze, this one felt right. Risk comes from not knowing what you're doing. Chubb's 84% combined ratio is the most direct answer to that quote that an insurance company can give. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. That's going to do it for episode 180 of Charged Alpha. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.